Yes. Now, as the United States and Israel escalate military action against Iran, analysts warn that the consequences could extend far beyond the Middle East, with implications for global oil markets, inflation, and cost of living in the countries such as Nigeria, Israel, and the United States, and as Nigeria. Israel and the United States launched missile attacks on Iran on Saturday. The strikes came 2 days after Iran and the U.S. held indirect discussions over Tehran's nuclear program, echoing a similar episode last June when Israel struck Iran's midway into negotiations between Iran and the U.S. The renewed escalation is already reverberating across global energy markets. Brent crude rose by 3.66% to trade at about $73 per barrel, with concerns mounting over the strategic Strait of Hormuz, a vital artery of global oil shipments. The ripple effect may soon be felt across many oil-dependent economies worldwide, including Nigeria. Meanwhile, the Nigerian government has called on warring parties to end hostilities and resume dialogue. Amidst the attacks on major oil and trading companies have reportedly suspended shipments through the Strait of Hormuz. My guest is Mr. Justin Chukwu. He is the founder, Group Managing Director, Cowrie Assets Management Limited. He will help us unpack this and tell us what we should expect. Mr. Chukwu, good afternoon, and thank you for joining the program.
Good afternoon, Tony, and thank you for having me.
Mr. Justin Chukwu, I'm sure you heard my intro. Crude price is looking pretty well. It should be a time where we should be very happy that more money will come into the country. But at the pumps, now we're already paying more. I'd like you to first make us understand what you make of all of this crisis in the Middle East and what it means, not just for Nigeria, maybe the continent.
Well, okay, starting from the issues in the Middle East, of course, everybody is fully aware that the US and Israel attacked Iran on Saturday, and that was on the 28th of February. And then we've seen Iran retaliate by attacking almost all the Gulf states almost all the Gulf countries where US has a military presence or allowed their country to be used as a base for the attack. So we've seen the attacks lead to two or so oil tankers, oil vessels being struck in the Strait of Hormuz, which has basically crippled shipment through that channel. And we know that about 20% of global oil exports goes through the Strait of Hormuz. So that means at least 20% of global oil supply have been shut in. Then we also know that Qatar, which is the largest exporter of liquefied natural gas, has shut down their production because of this ongoing war, because I think the facility was struck. We know that Saudi Arabia has shut down its greatest refinery or largest refinery because a part of it was hit by a missile or a drone. So that means even refined petroleum products production or refining has been shut in. Other alternative energy source, which is liquefied natural gas, has also suffered a shut-in. So in effect, we are going to be dealing with a global shortfall in energy supply. I repeat, global shortfall in energy supply. And bear in mind that major industrial manufacturing base of the world get their crude oil supply from through the Strait of Hormuz. China, for instance, India, Japan, and China and India are the world's industrial warehouses. So if they are not able to get their energy supply, given that LNG has also been shut in Qatar, then you're going to see global production will slow down. You're going to have, which could lead to a major slip in the global GDP growth, global GDP growth. That's as it relates to the world. Of course, anything of that nature will lead to an uptick in inflation because today crude prices have gone up to about $83 for the Brent crude. And then you're going to see refined petroleum product price will go up. So you're going to see an uptick in inflation rate. If that is further compounded by a reduction in production in major producing centers of the world, that means you're going to see fewer goods coming into the market, and with sustained demand, food prices are going to go up globally. That's how it relates to the global environment. If you want to bring it down home, we are going to get the benefit and also suffer the consequences or the implications of increase in crude price as well as increase in refined petroleum price. Already, we've seen, like I said, we've seen crude price about $83 per barrel for the Brent, which is an equivalent of our Bonnet Light, our category of crude we produce, or the class of crude we produce. So that would ordinarily mean that we should expect an increase in foreign exchange earnings. But that increase in foreign exchange earnings will partly offset by increase in the price of imported refined products. Good thing we have a Dangote refinery that is a local producer. But beyond Dangote refinery, we still do not have enough refining capacity locally. So a part of it will still have to be imported. And the cost of that imported petroleum, of course, Dangote has also adjusted its figure because crude, which is a major feedstock, is priced in dollar. Whether it's getting the crude locally or importing it into its refinery, Dangote has to pay international price for crude. So what that means is that you're going to see the reversal we saw in inflation rate to 15.1% make a reverse. I mean, the reduction in the inflation may reverse. We may see an increase in inflation rate, which will hurt household income. Whereas on the converse, we may see an increase in foreign exchange earning from export of crude because of increase in crude price. But unfortunately, we are not in a position to increase our crude production. I wish we are like Saudi Arabia, that can easily increase its crude price at short notice. We would have enjoyed more benefit of this war.
Detailed, I must say. Mr. Johnson, do we have any opportunities here? Because you already talked about it while wrapping up now that we cannot just increase production really at this time. But really, are there any opportunities? Because, you know, analysts would always say, when we have wars and issues like this, sometimes we have opportunities. Because I'm thinking like a layman would think, we have reserves of gas, proven and unproven. What is happening? Why can't we take advantage of some of this sometimes?
Yeah, totally, because we haven't built the infrastructure. You know, the thing is, they say good luck is when opportunity meets preparedness. But we like to ask, are there opportunity we can exploit from this? And I think we need to develop an investment proposal and go to Western investors, including private sector investors, to invest in our gas exploration and transportation. Today, we have been thinking of building a gas pipeline from here to Morocco. Probably we should focus on building another liquefied natural gas. We are toying with the idea of building a gas plant, an LNG in Ondo State. We were thinking of building an LNG in Brass. I think it's time for us to focus on that, because we're likely going to go to investors with, look, we need to develop alternative energy supply source other than the Gulf region. And that way, we will be able to attract investment if we make a good investment case to build additional facilities for. So if anything, because the Gulf region have remained a very volatile region, and I don't think even after this war, that region will cease to be a volatile region. So global investors are looking for alternative energy sources. Assuming we had the capacity to export crude, additional crude, we would have been the bride. But now that this has actually nudged everybody's consciousness on the need to decentralize the source of energy supply, I think if we make an investment case, we should be able to attract capital that will help us develop our gas infrastructure, so that at periods like this, even without a period of a development of this nature, we should be able to export gas to other parts of the world, beyond what we're currently exporting from our LNG, liquefied natural gas, existing liquefied natural gas scheme.
I must tell you that I'm also concerned about what we'll call the gains of this administration. According to them, they've been counting the gains. And one of it is what you talked about, inflation at 15.10%. We also saw last week that the MPR was reduced by 50 basis points. So, you know, that easing mood already started. Now, my question to you really would be, again, that will this not truncate or affect some of the good projections and figures that we've seen? Particularly, you know, I'm concerned because it's a pre-election year and everyone is, you know, very soon politicking will start real deep everywhere.
Yes, to like I rightly said, like I said earlier, we may see the gains in inflation reverse to some extent. With pump price, I think number of filling stations in Lagos are already selling fuel at above 900 naira.
Yes.
I think 935 or so
Yes.
uh, naira per liter. What that means is that cost of transportation will go up. When cost of transportation goes up, the cost of transporting food and
Go
food
up.
items will. So that means food prices will go up.
Yeah.
So if that happens, then you're going to see an uptick in inflation rate, which, like you said, will reverse some of the gains so far made by the current government. Beyond that, there's actually another concern that foreign portfolio investors, as a result of their flight to safety, will reduce their appetite for Nigeria's fixed income securities. Not necessarily because of Nigeria's any worsening of Nigeria's sovereign risk, probably because they want to, first of all, move to safe locations. So they're going to pull back and move to countries like the US, Western and other Western countries' investment instruments. And then if that happens, then you're going to see a material reduction in your reserve. Any reduction in reserve will mean that the central bank will allow Naira to adjust downwards, and that could further kind of fuel inflation pressures. So I think there's now a threat of a reversal of the gains in inflation rate. But there are too many balls in the air that a lot will now depend on how effectively the central bank reacts to this. But I also mentioned that, look, on the positive side, we should have improved balance of trade because we are likely going to see price of our major export products at what we call terms of trade improve. So that will help us compensate for any shortfall in foreign capital importation or capital importation if we manage effectively our exchange rate and ensure that whatever benefit we get from the sale of crude flushes into our reserve.
Mr. Chukwu, finally, it's indeed something to worry about. If this is prolonged, many analysts have said, oh, hopefully it's not prolonged, it's for a short time, but we can't even say, we don't know what this may mean moving forward. So let's look at the medium to long term. If this continues, what should we expect clearly as a country?
Well, to leave this continues, the factors are going to be very complex, but I don't think it will continue. Let's even start from if it continues. If it continues, you are going to see scramble for oil produced in the world. Prices could get to $150 per barrel, which will strengthen our external factors. We could see our reserve climb precipitously to approaching $90 billion, which will be good for us. But we'll also see a higher level of inflation, which I said, look, commodity prices, price of finished goods, import will go up. So that will also mean that we're going to see increase in import-induced inflation. We are going to see increase in the effect of increase in refined petroleum product prices. So at the micro level, households will suffer some difficulties. Conditions of household income will standard of living will worsen. But at the macro level, the government will have more reserve. And depending on how it deploys that reserve, we should see a strengthening of Nigeria's fiscal condition.
Well, let's leave it at that and see how all of this plays out. Let me get one word from you again before you go, Mr. Johnson Chukwu, with regards to the reduction that happened at the last MPC meeting. Was that what you were expecting?
Yes, so I think I was in your program and I said that I expect the Monetary Policy Committee to reduce rates. The simple reason is that we saw a material decline in inflation rate, we saw a major uptick in reserve. We saw a strengthening of Naira. So these are key variables. And at the global economic environment, things were relatively stable. Nobody could have foreseen the strike, this war going on now. Of course, the talks were then ongoing. So we also saw food inflation drop to about 8.89%, which all this made it compelling for the Monetary Policy Committee to reduce rates. And I also just say that, look, there is complete disconnection between the monetary policy rates and interest rates within the Nigerian economic environment. You have a monetary policy rate that was 27%. You had T-bills, said the 364-day bills are 15.9%. So you need to bring down monetary policy rate to be in tandem and realign it with interest rates obtainable within the economy.
Mr. Johnson Chukwu, founder, Group Chief Executive Officer, Carrier Asset Management Limited. Thank you so very much, as always. Thanks for making sense of this topic of discourse.